Welcome back to Rockstock Channel. It is Thursday, August 15th, and we are privileged to have today Paul Gait, Group Head of Strategy at Anglo American, to talk about copper. As mentioned in our latest Lithium-ion Bull newsletter, I formed RK Equity 22 years ago through my chance introduction to mining legend Robert Friedland in the summer of 2002. It was a deep bear market for commodities, post 9/11 and post the Bre-X gold scandal. At age 33, I was, for the first time in my career at that point, at the right place at the right time, learning the junior mining market at the knee of the master, telling tales of Dr. Copper in Mongolia feeding a China-led commodity supercycle. Rodney and I started working together in 2018, in the middle of the last lithium bust. Our hard work into that downturn paid off well as we found ourselves again at the right place at the right time for the 2021-2022 EV supply chain mega boom catalyzed by significant government and monetary stimulus peak COVID during Biden's term. Build Back Better industrial policy, a Green New Deal aimed at alleviating climate considerations, and to catch up with and mirror China. 18 months into lithium's latest bust, we remain bullish on select lithium equities with a 3 to 5 year view. Lithium demand today has surpassed our expectations from a few years ago and should continue to grow at 20% plus per year, unprecedented for any commodity. The lithium-ion battery, which underpins electric vehicles and increasingly energy storage solutions, will continue to dominate. But as American and European automakers, and even Tesla, have pared back their near-term EV production targets, the lithium bull narrative has circled back to become again a China-dominated story. We've argued for years that lithium's abundance should ensure it won't be substituted, the irreplaceable element of the electric era, as VW called it 5 years ago. Back then, in 2019, Rodney and I interviewed Javier Martinez of Morgan Stanley, who covers SQM, and has largely narrated a bearish tone. Javier has argued that, like any other commodity, it is not demand, but supply that determines price. Lithium is easier and cheaper to find than copper. The recent boom attracted a lot more capital for lithium exploration. Spodumene and lepidolite mines are also a lot smaller, cheaper, and faster to build in certain geographies that China has exploited very intelligently. SQM has ramped up lithium production faster than Javier or we expected, thanks to distorted incentives created by the Chilean government. But today's oversupply has more to do with China government and corporate support for higher cost sources of raw lithium supply in China and Africa that surprised most Western observers in its quantity and speed. And throughout COVID, China built world-class, low-cost processing facilities that have kept its EV and battery supply chain well supplied with battery-grade chemicals. We agree with Albemarle, Arcadium, and others that lithium prices have to rise closer to $20,000 a ton if ex-China supply is to be incentivized. But that is an important if. For now, as most Western OEMs are losing money on all their EV sales, they seem in much less of a hurry than 2 years ago to lock in long-term supply agreements for new projects ex-China. We expect this should change. We believe lithium could triple from today's 1.1 million tons to 3 million tons plus by 2030, as Albemarle currently forecasts. Much of this will come from markets outside China, which will require many mine and processing facilities outside of China if we want to have supply chain security and resiliency. Pilbara's prescient all-stock merger with Latin Resources announced last night is a testament to this long-term logic to supply North America, Europe, as well as China. Undeveloped spodumene products will remain in high demand in Brazil, Australia, Canada, Africa, and elsewhere. Recall, it did not take much of a lithium supply deficit to cause 2021 and 2022's boom, nor that much of a surplus to create the current bust. But it's hard to predict the timing. The U.S. election outcome is one of dozens of variables creating uncertainty, and markets hate uncertainty. Rodney and I look forward to continuing our deep analysis of lithium supply, demand, and pricing, and presenting companies we think have good potential to become important suppliers in this rapidly growing industry. But having experienced another boom bust in a short space of time, we recognize that specialty chemical lithium is not so special. The lithium supercycle is less super and more cycle. With few exceptions, like Pilbara, lithium is a commodity trade like no other, more so than a hold on for dear life mid to long term investment. Lithium has been the best performing commodity in 4 of the past 10 years. It has also been the worst performing commodity in 4 of the past 10 years. Outside lithium, Rodney and I have covered nickel, graphite, and other niche metals like titanium with Hyperion X over the years, and we will continue to do so. We have been researching cesium and what Power Metals has discovered in Canada, following Winsome Resources' prescient 19.9% investment last year. But we've also convinced ourselves that for our electrification of everything future, mainstream Dr. Copper looks very strong with a 5-year view. So we're coming back to our roots and joining some of our peers like Benchmark Minerals in providing our own analysis and commentary on the red metal. Starting with our guest today, Paul Gait, who I reconnected with at Benchmark's Giga USA event in Washington, D.C. in June. Paul recently rejoined Anglo after a storied career at AllianceBernstein, where Robert Friedland would often circulate his insightful work about copper markets. But he had previously worked at Anglo before Bernstein, as he'll talk about when we introduce him. While copper is a relatively large, mature industry, for equity investors, it is a market largely dominated by specialist institutional investors and industry players, but not well understood by retail investors. At 25 million tons annual production and around the $9,000 price, copper is more than 20 times the size of the lithium industry in volume terms and more than 15 times in value, a $225 billion market compared to $13 billion for lithium. The high caffeine Red Bull story is underpinned by this chart, which argues that more copper will be required to be produced and consumed in the next 22 years than all the copper produced throughout world history. If this is accurate, another 25 million tons of copper will be needed to be produced by 2045. Just as the world may need 11 to 19 Pilgangoras for lithium, massive investments must be made in copper exploration for new discoveries, and for multi-billion-dollar development projects which can take 10 to 20 years to get into production. The demand underpinnings for copper are similar to lithium. Electric vehicles and batteries are far more consumptive of copper than traditional ICE vehicles. Additionally, charging stations and AI data centers will require enormous amounts of copper, on top of copper's traditional uses in all sorts of construction, household and hospital goods, like refrigerators, air conditioners, wires, and pipes. Military applications, too. Which is why BHP and Lundin formed a 50-50 joint venture to acquire Greenfield Filocorp in Argentina for more than $3 billion last month, and why Robert Friedland's Ivanhoe Mines sports a market cap of $15 billion, nearly 3 times the size of Pilbara's market cap. I don't own any individual copper equities, but have held Global X's copper ETF, COPX, for many years, the top 20 companies of which will flash up on the screen now. Not investment advice, do your own research, but we're intrigued by copper and starting to learn through our research of Anglo American. Anglo American is listed on the London Stock Exchange main board, ticker symbol AAL.L, and also has a US ADR, ticker symbol NGLOY. The shares are currently trading at about 22 British pounds, or 14.5 US dollars, which equates to a 26 billion pound market cap, or 33 billion US dollars, which is down 21% from its 52-week high of 28 pounds reached in May during BHP's 31 pound per share bid. According to Anglo's recently published Q2 results, the company had $31 billion in revenue, $10 billion in EBITDA, and $3.9 billion in operating profit. Anglo is a diversified mining conglomerate with operations in copper, principally Chile and Peru, as well as nickel, PGMs, diamonds, iron ore, met coal, manganese, and polyhalite. This diversity likely explains why Anglo is not among the copper ETF's index, even though copper was the main reason for BHP's bid, and copper accounts for 41% of Anglo's EBITDA. I presume Global X will add Anglo to its ETF in time, as following the rejection of BHP's bid, Anglo has announced plans to simplify its portfolio into copper, iron ore, and crop nutrients. Expect to see lots of divestments and demergers coming soon. I've been hearing for a decade from Robert Friedland that we're going to need a telescope to see the copper price. Quoting him from a recent Rick Rule symposium, we see a crisis coming in physical markets and a need for much higher prices. Copper demand is essentially infinite, due not just to electric cars and artificial intelligence data centers, but also modern warfare. Military demand for this metal is going to go to infinity in the next few years. More than 10 years ago, Paul, you wrote at Bernstein suggesting copper would hit 10,000 back then. But it was only earlier this year that copper finally hit that figure and has since retraced to around $9,000. We look forward to getting into why it took so long to reach this milestone, and if the recent pullback is a good dip buy opportunity to get exposure to copper ahead of a sustainable run over the next several years. And with that intro out of the way, welcome Paul Gait for the first time to Rockstock Channel. Let's start with a bit of your background, the current Anglo story, and then let's walk through some of the slides you presented at the benchmark event underpinning your copper thesis. Rodney will then join with some questions testing that thesis.
Brilliant. Well, thank you very much, Howard. Absolute pleasure to join you, and really nice to sort of reconnect after quite some time. So very glad to be here. Thank you for having me.
All right, great. Just give us a bit of your background. I thought you actually were just at Bernstein, but apparently you started your career at Anglo.
That's right. So I joined Anglo from the UK government, from the Treasury, working for Gordon Brown back in the day. So I joined under Tony Traer and Tony Lee when they were CEO and CFO. Spent nearly a decade here in Anglo American before the lure of the city pulled me away, where I joined Bernstein, published research on the global commodity markets, the major mining companies, and also our friend Ivanhoe and Robert Friedland's discoveries, and just the incredible story that was the development of and creation of, as you say, a $15 billion copper giant today. Over that period, as I say, covering the commodity markets, covering the global macro, covering the mining sector, for Bernstein. I then left Bernstein in 2019, was then CIO of an asset management firm based out of Spain and London called As Valor. Spent 3 years there. Great time, great set of people, really enjoyable opportunity to sort of put other people's money where my mouth was, but nonetheless to see the industry from the buy side as well as the sell side before rejoining Anglo just over a year ago as group head of strategy.
Okay, that's great background. And at the benchmark event, I was very impressed to hear your presentation. You shared your slide deck with us. We're going to flash some of those slides up as you're speaking, to this thesis. But if you could just go through that in maybe 15, 20 minutes. Why are you so bullish copper? But also, if we can kind of like turn the page back to kind of 10 years ago with this research report where you're forecasting 10,000, like what happened? How did copper, just flatline for, or it was volatile, but it's been a difficult, period. Where did the supply come from, given the demand fundamentals, I think have still been pretty good over this 10-year time frame?
Yeah, no, so look, it's a really interesting question. If we go back sort of, 10 years ago when I was sort of starting off really the career in Bernstein, what we had back then was a consensus price deck, across the board that was deeply backwardated. We had a whole host of very sort of bearish long-term expectations. Now, of course, if someone says that they can second guess weekly movements in any commodity price, I think sort of more fool anybody for believing them, right? These things are very volatile. They are stochastic, not deterministic processes in nature. And of course, when, sort of a magician says, I can do magic, who's the greater fool, the magician or the people that believe him? So short-term sort of commodity price forecasting sort of is not where I am, right? What I am, however, sort of is looking at and very interested in are the long run drivers of industrial activity, of economic growth, of wealth creation, and the role that the mining industry plays in underpinning that. And at that time, it was very clear to me that the negative thesis around the long-term commodity price was deeply mistaken. And that's what I was sort of trying to correct. So there are a number of things, even back then, that you can see have risen to the fore in popular consciousness, or at least, in the mining industry, that were very evident back in the day. These were really around the sort of essentially the geological scarcity, of copper, and what it takes to bring supply to the market. And look, you touched on that sort of, Howard, around this sort of perennial debate. Is it the demand side of the equation, or is it the supply side of the equation that sort of sets the long run price? Now, of course, it's the interaction between those two, but sort of as an Austrian, Austrian economist, I'll always lean into it's the supply side structure that we really need to understand. And that the demand side, is going to always set the, it's always going to be there. It's always going to be volatile. We're always going to have the cycle. But fundamentally, it's that long-term structure that we're looking at. And back sort of 10 years ago, the issue of grade decline, which of course we're all talking about today, was very, very visible. You could see what was happening with the reserve grade versus the head grade of existing production. You could see what was happening with the exploration profile. And of course, Ivanhoe is the exception that sort of disproves the rule here in terms of what people were able to find and the quality of the geology that people were able to access. At the same time, the productivity in the mining industry had started to slow down quite dramatically. So if we take the last big period of falling real prices, right, the last sort of stagnation in the sort of commodity markets, and of course you touched on that sort of point, 2002 was that nadir sort of in that sort of cycle prior to the sort of rise of the sort of Chinese industrial sort of might. But what you'd had over that period was a period of exceptional increases in productivity. That productivity increase had fed through into sort of cost structures that were both flattening and falling. And of course, as those cost structures flattened and fell, that of course created a deflationary sort of price environment. And the deflationary price environment was more than able to offset the geological sort of conditions of, let's say, falling head grade that would otherwise act as an inflationary sort of factor. So in mining, we always have this interplay, right, between productivity, long-run productivity gains, which tend to be deflationary, and the simple sort of ability to access geology, which tends to be inflationary. Because as mining engineers, as good sort of capitalists, we always maximize NPV. And what does that mean? It means bringing forward as best we can the fairest portion of the geology that we have in our reserve base and exploiting that preferentially. And that creates an inbuilt tendency that what comes later will almost invariably be higher cost or in some way more challenged than what we are accessing today. So that's the dynamic that's at play. And of course, I just didn't think that dynamic was being adequately discussed in the research. What we had instead were people trying to second guess the 6-month supply demand balance, right? As if they had access to a sort of copper price forecast that could be known plus or minus, X over a very short term period. And then just simply extrapolating that into the longer term. So that's what I was sort of trying to sort of do whilst at Bernstein, is just draw attention to those long run structural forces, both on the demand side and on the supply side, that ultimately dictate price. Now, of course, what we didn't sort of really anticipate was the sort of hard landing in the Chinese economy that took place in sort of 2015, 2016, the over tightening, the sort of self-imposed sort of shock that caused to Chinese sort of economic activity. And, what you really had across a number of commodities during that sort of period, 15, 16, was the sort of combination of supply growth that had been incentivized in the last cycle, coupled with essentially demand growth that was falling away from you, as you had this sort of China shock. So it was the confluence of an acceleration on the supply side, deceleration on the demand side, significant sort of oversupply. And then you saw that sort of, not just in copper, but across the entire sort of commodity space, acting as a very, very negative sort of shock to the downside. But look, this is mining. We know the sort of truisms. The solution to low prices is low prices. The solution to high price is high prices, right? The cycle will always be with us. And, you touched on that indeed when you're sort of discussing the sort of lithium dynamic, right? It's always going to be there. And of course, what we know is, the temptation is always for euphoria at the top of the cycle. and despair at the bottom. But the good times, frankly, are never as good as we think they're going to be, and the bad times likewise, right? So there is always this sort of self-correcting dynamic, in these commodity markets that will ultimately sort of play through. But when it comes to sort of copper, where we are today, we're starting to see some of these issues really enter, I think, the sort of mainstream sort of consciousness of both the sort of sell side, but I think also increasingly in terms of the market and awareness of, what it will take to create the next wave of supply. And there are just a number of factors there that just make this difficult, right? It's difficult enough at $9,000 a ton, right? And you can see, therefore, in the revealed preference of companies like, for example, BHP, but others as well, what the price would have to be to create new supply. And I think it's two things going on here, right? From an investor's perspective, there are two dynamics, right? One of which is the rating on which the sort of mining companies trade, and the second of all is the earnings that they're capable of generating. In other words, the commodity price. And either of those two factors can create an investment opportunity, right? Ideally, what you're looking for is undervalued stocks at the bottom of the commodity cycle. You get in there, and then you can ride both earnings appreciation and multiple expansion through the next sort of cycle. But when you sort of look at copper, we've got two things, right? The copper price just frankly isn't high enough, and the cost of capital to the mining industry is too high. Add those two things together, and of course, you've got the situation that we see today, which is it's just very difficult for new copper mines to be built. And of course, that's what creates the dynamic that will support medium to longer term prices.
Okay, you said a lot in there. Thank you for that. I listened to a podcast yesterday from our friends at Fast Markets with the CEO of Freeport, and she was mentioning there were brownfield expansions. There were also, reprocessing of tailings. So how much, copper is an established market. Are there a lot of like mothballed, brownfield mines available? We used to work with what is now Atalaya Mining, which was the old Rio Tinto mine in Spain, and that was kind of like a restart. Are there a lot of those opportunities out there if copper prices rise, or how much needs to come from like new discoveries like Robert Friedland has done in Mongolia and now the DRC?
This is a bit of a sort of chicken and egg sort of situation, right? And of course, I think the other thing that we're sort of looking at here is just the sort of depletion rate, in the existing sort of supply base. And that depletion rate is really two things, right? It's a combination of, in certain instances, finite reserves. Once they're exploited, they're sort of, gone. Of course, there are other systems, the big sort of porphyry systems where, these will sort of keep on giving. But of course, you do have other mines where there's a, very sort of finite reserve life. And then you've got this issue of grade decline, right? And this grade decline is sort of more than just sort of, the sort of head grade, but it's also the whole sort of geological complex, right? The stripping ratio, the ore hardness, the ease with which you can process it, and the recovery rates, and so on and so forth. So that creates this sort of constant sort of drag in terms of supply that you've got to overcome. And if we look at just, how has the industry behaved sort of historically, that probably gives us a fair sense, right, of what's going to, what we should expect going forward, right? Which is if you look at sort of what the expectations were versus the outturn. And to your point, what we saw over the last 15 to 20 years, let's say, right, is an awful lot more brownfield projects, right, were approved because these big, low-cost greenfield sources of supply that everybody was expecting, this sort of wall of supply, which was a narrative that was being sort of put around the city in sort of 2016, 2017. There's this infinite wall of supply that's going to come flooding into the market. As it sort of realized that that wasn't going to sort of come to place, of course, then the price rises. That then creates the dynamic wherein you're going to find, right, sources of rock, sources of material that you can put through existing infrastructure, mill plants, and so on and so forth. So typically what you tend to see is that the expectation of greenfield projects disappoints, right? They're harder, more difficult, and they take longer time. And what, on the other hand, is it is the brownfield sort of sources of supply that that move to sort of fill the deficit. Because of course, an important point here, Howard, is that it's very easy to sort of draw sort of supply demand balances that show us negative 2 million tons deficit by 2030 in copper or whatever commodity. But of course, we know that there's no such thing as a negative balance of any metal, right? supply and demand are just labels given to production, right? And what we're asking is, what is the price point that will ensure that that production continues to grow? So we'll never actually have a sort of deficit in that sense, of the metal. What we will actually have is a price line that sort of iteratively tests the cost structures of an industry, trying to sort of work out, as it were, where the lowest cost solution for the delivery of the demand, that people have, in how that can be met, whether or not that's through scrap metal and recycling, whether or not that's through, as you say, reprocessing of tailings, novel sort of leach solutions, brownfield developments of existing mines, and so on and so forth. So, in the case of, let's say, Freeport, they sit on these mines that have been this golden goose for a very long period of time. There are significant sort of resources that they have had and will continue to have, that given their existing infrastructure, they can continue, to maintain supply. Others, of course, are not quite so fortunate.
So just if we can, while we're on that point, Paul, before I go to some other questions, are you saying then that to some extent there isn't enough incentive? Because clearly if we see this huge need for supply going forward, there should be a lot of capital being deployed into exploration.
Yeah, it should be sort of capital being deployed throughout the value chain, right? And what we're sort of seeing here is that, I would say not enough is being, put into exploration. And what we're getting out of exploration for the dollars that we're putting in isn't good enough either, right?
Yeah, that's a great point, because you look at the number of discoveries over the last period, and one would think, given the rise that like we've had in lithium, a lot of capital's being deployed, and yet we're not seeing the discoveries in copper.
And exactly, and that's in a certain sense because kind of we're looking in the wrong place, as it were. When we think about where the next set of deposits, the next set of discoveries is likely to come from, we are probably looking at, for example, Kamoa-Kakula, undercover, right? No visible sort of mineralization, no visible outcroppings. You had to think differently about the geology. You had to think differently, about the underlying sort of processes to sort of give yourself a sense of being able to, find an asset like that. And, our own exploration assets, our own exploration efforts in Anglo very much, recognize that, conditions, have changed, right? And that if we're just sort of going to apply the same technology to the same areas, that we have looked at multiple times already, the outcome isn't likely to be any different than what has been historically. We are going to have to think about this, this differently. And so I think, one of the sort of challenges, of course, is that is kind of riskier, right? The temptation is always to stick with, the pre-established sort of modality, the pre-established technology in the regions in which you are comfortable sort of operating. But of course, by definition, they're the reasons that have kind of, let's face it, been drilled like Swiss cheese, right? So going back there and trying to think that you're going to find something that no one else has found for 100-something years, despite sort of constant sort of exploration effort, that's kind of unlikely. So we've got this issue on, as you say, on the exploration side of things. But then it's also this question about development, right? The societal pressure on mining is extraordinary, right? By way of the things you have to do to permit, to get approvals, right? And this is, I think, one of the fallacies that you see, an implicit fallacy, right, with the incentive price methodology that is used, sort of almost ubiquitously by the city. The implicit assumption there is that the only sort of impediment to the development of supply is capital, and that if price rises to a sufficient point, capital will flow and create supply. And all we're trying to do is work out at what point will capital inflows create sufficient supply. But as we know, it's not just that. It's around the social license to operate, right? It's around permitting, right? It's around environmental custodianship. It's around issues around water, issues around dust, creating that whole set of things that, of course, you can say there is a capital cost associated with it, but that's not really the issue. It's being able to manage those issues, right? And meet societal expectations for this, the way mining should function. That is just as important, as the, the capital bill, itself. So in the case of something like copper, what we're seeing is the price has to be even higher to overcome some of those non-traditional barriers to entry in order to create the, in order to create the supply. But at the same time, this then comes down to the sort of preference, of, broader society as articulated in the valuation of mining companies, when mining companies trade on 4, 5, 6 times EBIT, what you're really doing is putting a brake on growth, right? If you want to precipitate growth, if you want to create the kind of growth that you see, for example, in the tech sector, it's not the case that the multiple reflects the growth. It's the multiple causes the growth. It's what delivers the low-cost supply of capital that has enabled them to create this proliferation of sort of entertainment services that surrounds us today. If we really wanted to fix the aggregate decarbonization, environmental, and frankly also just standard of living challenge that faces the global economy today, we could do so. You would do so by a reallocation of capital away from non-productive to productive sources of economic activity, a re-rating of the entire sort of industrial sort of space. And that would liberate and incentivize the capital to flow to those areas that would then create the supply in the materials that we need.
Paul, just on that point, have there been advancements in the sort of carbon emissions or on streamlining production in copper where it leaves less of a footprint in all aspects?
Look, certainly when we sort of, I'm thinking here about, there's a number of sort of things, that are sort of going on, one of which, of course, is, looking at the sort of carbon intensity of, some of the simplest things is just around sort of, sourcing of power, right? Being able to actually just go out and sort of, buy, in the case of Chile, for example, green energy is cheap energy, right? It's kind of a no-brainer where we've got this sort of, virtuous sort of cycle where when, you can reduce your carbon footprint simply by the sourcing, of green and sort of cheap energy. And that's both, it's aligning the social and the private and the public utility, right? It's both value accretive for shareholders, and it's also, the good thing to, to do. But of course, beyond that, you're looking at sort of in trucking, right? How can we sort of reduce carbon intensity, of the mobile equipment, right? What do we need to do there by way of, electrification of the, of the fleet, trolley assist. We had, various initiatives, and of course, across the mining industry, you look at, say, the likes of Caterpillar, Komatsu, and so on and so forth, some of the thinking that they are doing. But, so from a sort of CO2 footprint, from an environmental footprint, there's an awful lot of, progress that the mining industry has made to, to increase or rather to reduce the impact of the, the footprint and increase the, the sustainability of the practice. And, something like sort of Quellaveco in the case of Anglo American is something we sort of take sort of great pride in, having been able to deliver one of the few sort of greenfield projects, genuinely greenfield projects that we've seen over the last, over the last decade, and to do it in a manner, particularly through COVID, that respected those sustainability principles that are going to be so important for delivering the next wave of supply.
Okay, if I can, I suppose one of the things that that I look at is I look at the sort of historic rationalization for copper intensity and so on, and I look at what's going on in the world, and I just want to stress test with you a bit, Paul, about some of the things that are happening. The adjustment in demographics and populations are changing. We've got a lot of countries that are at a very high debt to GDP. If we can just start to just stress test, the construction sector and property is important. China seems to be rolling over. They seem to have hit a bit of a wall. Their population is projected to age. So if there's a slowdown and a rolling over of property, how's that going to affect copper demand in all the models?
There's always going to be the economic cycle here, right? No one had Chinese GDP growth at 10% flat forever. I think everybody sort of recognizes, right, that as a country matures, it's just sort of economics kind of 101, that kind of growth rate is going to decline. And of course, as you say, the property sector in China is, China is what, 50% of the global copper market. Property is whatever 30% of the the Chinese sort of demand for for copper. As that declines, as that sort of has an impact, of course, it's gonna sort of shave some off the demand growth. But of course, that doesn't last forever, right? Eventually you do find sort of a sustainable run rate even there. As the demographic sort of ages, of course, I would say, right, if you look at GDP per capita, what that implies, of course, is that there's significant upside in terms of the capital stock China needs to accumulate in order to offset the productivity drag of a declining sort of, a population, slowdown, right? So if one had a sort of simple factor model of economic growth, sort of productivity factor, factor productivity, capital stock, and sort of population, what we need to see is, I think, continued, upgrading of the Chinese capital stock. And I think that's part of the sort of language that we're seeing, in China about increasing the quality of their industrial sort of activity, moving away from just, construction, but into other forms of investment as well. Because I think it's also a sort of truism. So if we look at some of those sort of Chinese figures, what we've still got is a very, very high savings rate, right? And it's that very high savings rate that underpins the investment rate that we have in China. And that's likely to sort of continue. But of course, on top of that, what we've also got is urbanizing, right? East Asia, right? We've also got, the growth that we can expect to see, out of India, right? And again, of course, I don't think anybody thinks that, India is going to parallel what we saw in China. But nonetheless, if you look at India's growth over the last decade, if you look at their ambition of where they, expect and want to be, I think there's every reason to be sort of positive around the longer term growth. Just to give some of these sort of figures that Howard was sort of touching on earlier in his conversation, if we look at Western world, let's say, what does it take to create wealth in the Western world, right? It takes capital. But what is that capital? The reality of it, of course, is not dollars and cents. That's just the symbol economy. The reality of it is tons of steel, copper, cement, and so on and so forth. In order to create the standard of living that we enjoy in the West, we need 200 to 250 kilograms per person of copper embedded in that capital stock. That's what forms the basis, right, of our standard of living. It generates the services that enable us to have the high levels of output that we enjoy. So 200 to 250 kilograms concentrated in a population of about 1 billion people in the developed world, right? The global average is 60 kilograms of copper. And in the developing world, it's closer to 20 kilograms of copper. The delta, therefore, is between 60 kilograms to, let's say, 260 kilograms, 200 kilograms per person on 10 billion people in the planet, right? You can do the math, right? That's 2 billion tons of copper. The sum total of all the copper that has ever been mined through human history, right, is about 490 million tons, let's call it that, right? So hence, that's where you get these kind of numbers being generated. The longer term sort of demand for this material, right, is underpinned by the basic desire of people for their children to have a better standard of living than they themselves enjoyed. And that's before we add on, right, the Internet of Things, before we add on, right, decarbonization, before we add on all of the new applications for copper that human ingenuity is capable of creating. And of course, this is Jevons paradox. Jevons was writing in the sort of 19th century or whenever it was about the nature of economic growth and material intensity that sort of sits behind it. And as he sort of pointed out then, just as we decrease the material intensity of existing applications, new applications are always being unlocked by that process. And think about, data centers and the copper intensity of data centers, let alone sort of artificial intelligence data centers, the amount of energy they consume. And the most efficient mechanism for creating those services is, of course, through materials like copper.
So if we can just touch on that, because as those applications come through, there's also thrifting and improvement. So one of the things that's coming up now is 800 volt charging on EVs, which requires quite a lot less copper intensity in the vehicle. We've got plug-in hybrids. I have a theory on that. I think China's trying to push so hard to push its production volumes and take rest of world market share. Places like my old homeland, South Africa, and in Cape Town, there's I think 4 public charging things in a city of 4 million people. So they're not ready for full battery electric. So you've got an internal combustion engine infrastructure there, where it's popular for jobs and so on. The government gave incentives. So those types of things like plug-in hybrids being slightly higher, 800 volt charging. I don't know if fiber optics versus aluminium versus, say, copper, it doesn't mean to say that that's going to obliterate demand. Again, it's about supply and demand interacting. So if you've got the assumption of probable, possible, all of these things are binary. Is the lowering of the potential lowering of the demand irrelevant? Because if I look at supply charts, we really are running off a cliff. So does it really matter?
No, I think it's exactly kind of it, right? You get, as you say, and these are things that we've seen in all the commodity markets, maybe with the exception of aluminium, maybe the exception of aluminium, which tend to be the thing you substitute into, right, rather than out of. But you get two things, right? Into metallic or into material substitution, right? So steel for plastics, copper, aluminium for copper, and so on and so forth. And then, of course, you get thrifting. So not a sort of substitution effect, but just an outright sort of reduction in the sort of intensity or the material sort of loadings, right? And of course, in our own analysis, we try and sort of disaggregate both of those effects, in terms of the demand. And what we have, of course, is something of a chicken and egg effect, where these are price effects as much as anything else, right? So the incentive to thrift, what is the cross price and self price elasticity of the metal, right, over the short term and over the longer term? So what is this sort of temptation to sort of mix metals? And of course, in the short term, it's very, very difficult. But of course, over the longer term, it's human ingenuity kind of working out, actually, we're gonna do something different. Because of course, what you can't have, again, is, on the supply side or on the demand side, these negative balances of the metal, right? The market is going to clear. On the demand side, it clears through essentially, as you sort of point out, right? It demand destruction, right? Substitution, thrifting, right? And so on and so forth. And those are, therefore, when we sort of think about metal demand, it's kind of GDP growth rate, but these are sort of GDP minus, right? They're the things that move us away from that. Then what we get on the other side of it is new applications, right? So things that, novel applications that haven't been seen hitherto. And again, electric vehicles is a sort of case in point, and so on and so forth. And they kind of tend to act the other way. And then, of course, on the supply side, as we discussed. So, I don't think of these things, as sort of threats to it. I think that this is the sort of proper functioning of markets and the price signal kind of doing what it's supposed to do. I think we get into bigger problems when, again, as Howard sort of alluded to, sort of earlier, when that price signal isn't allowed to do the job that someone like, Mises and sort of Hayek would describe, right, as being so essential in communicating the information to market participants about, behaviors and how they should be acting. So, look, of course, it's something that's there, but I don't think of it as something that's going to derail, right, the prognosis, because again, fundamentally at heart, it's around the supply side structure, of the industry and the ability of that, that supply side to feed whatever the demand may be.
And just one of the things I've also thought a little bit about, Paul, is the ability of speculators to be able to influence and get involved in trading. Your thoughts on, is that just short-term aberrations like we've had now, and then we settle back? I know there was commentary from the physical side of the market saying this is unsustainable when it shot up and it's come back. Is that just a here and there, or are speculators, is there a danger that they interfere with long-term dynamics?
If you look at sort of net speculative positioning in, say, the metal markets, and you look at how that sort of correlates with the sort of copper price, and you can look at this sort of, various lags and leads, and you can do sort of various fun things with that, in sort of multi-factor analysis of the price. And certainly you can see the effect, right? And you saw it, this year, right? What we had, I think, was a combination of sort of some very sort of bullish reports around sort of artificial intelligence, and it got caught up in that whole sort of AI chat GPT kind of, bubble. And at the same time, of course, we also, had the, Anglo BHP, discussion of which I was, kind of part. And, that raised the sort of, I think, the awareness, right, in the sort of generalist market, again, of some of the issues that BHP and Anglo were discussing, as part of that process. And again, as you said, sort of focused, largely in discussions around, the nature of, longer term sort of supply of copper. So both of those sort of factors sort of created that sort of, that sort of a little bit of a speculative bubble. We saw it articulated in the price, and sort of no real surprise that then it sort of comes back down, particularly as you're saying, Rodney, in an environment where we've got sort of weakness in the sort of broader macro, particularly in sort of Chinese property. So I think it creates noise, and I think that noise can be somewhat unhelpful because it can sort of then often cloud the fundamentals, both in the negative and in the positive sort of sense of it, right? You get, again, it sort of amplifies the emotion in the market. Whereas what we're trying to do and what we need to do in order to make investments in supply is look through that to the sort of longer term fundamentals. And of course, sort of short term volatility, isn't terribly helpful when you're trying to sort of, when you are trying, therefore, to think about the medium to longer term.
There's clearly, as you've explained, the issues around permitting, etc. There's clearly, at the moment, at these prices, and with the complexity in the industry, a preference to buy rather than build. That's what we're seeing with everyone. So the question is, what is a clearing price or a fairer price where people are going to get the wheelbarrow and spade out and go looking and actually commit to building new supply versus looking to trade and take a macro view and say it's too cheap?
Yeah, look, I think two things there, right? You certainly, as you say, right, the build versus buy decision, right? And that's a function, again, as I would say, right, of two things, right? Valuations in the mining industry, versus capital intensity. So in other words, you're looking at the implied capital intensity of existing supply versus the capital intensity of, new build. And those two things are, mismatched, right? You could not rebuild Anglo American's copper business for the market cap of Anglo American, right? So, you've got this sort of tension here between what is embedded in the equity valuations and what is embedded in forward-looking capital intensity, right? And then, of course, you've got the price of the commodity itself again, right? Which would sort of suggest, if you're looking at the kind of analysis that we all do, right, about the nature of the imbalances that you're going to be seeing sort of going forward, and what that therefore implies about the value of existing supply versus future supply, bearing in mind the sort of lead times that it takes to develop develop these mines. So as you say, that all favors the the buy over the build decision. But of course, from a macroeconomic perspective, that all that generates, right, is inflation, right? That's the very thing. All it generates is price inflation because the actual supply, the actual new productive capacity, simply isn't there. So, when we then sort of think about, what does that imply for prices? Of course, the simple answer is higher, right? When we look then at the kind of shocks, however, that are created and that will be needed in order to sort of create that sort of those animal spirits and the resurgence of sort of genuine risk on activity, I think, that's kind of where the industry sort of often struggles, because the temptation is always, of course, to think about our sort of flat, long-term, real, commodity price expectations. But we all know that's not actually the way the market works. The market works in the way that we've just seen in lithium, right? The lithium price goes from whatever it was, I can't remember, sort of 8,000 to 64,000 bucks a ton, creates this enormous sort of wave of money that is then articulated and trying to articulate itself in new supply. And at the same time, it creates the risk appetite for investors to say, I actually want you to deploy that money in new sources of supply, other than just in, say, for example, buybacks, or dividends. So you need both of those factors, at work, right? And I think that that's kind of what we are going to see, right? We are going to see a continuation, of volatility. I think the amplitude of that volatility is going to be higher. And I think the trend line around which that volatility will fluctuate is also going to be rising.
So, Paul, we have a presentation that you gave at the Benchmark event, and any viewers of a Rockstock channel, if you'd like a copy of that, please email at rockstockchannel@rkequity.com, and I can share those slides. But fundamentally, Paul, we are focused on kind of equity investors, again, not investment advice, but Anglo American, is an investment opportunity for anyone kind of watching this. You made a comment that you couldn't build your copper assets in Chile and Peru for the value of what was it, $39-49 billion that BHP was bidding.
We can discuss what the actual sort of bid was, given it was a stock deal rather than cash. So and a complicated sort of stock deal as well. And look, probably I'm being a little bit sort of flippant there, right? But if you just look at the sort of capital intensity, right, of new supply, right, of of the project set that is going to be going forward, you multiply that through by the productive capacity that we already have. You add to that the cost of the infrastructure, the licensing, and the social obligations, and so on and so forth, that have enabled sort of companies like ours to have those sort of existing sort of those positions. And the maths tells its own story. And of course, that's of course the trade-off, right? Can you build new supply? What is the capital intensity of new supply, right? When I started writing, everybody was sort of saying, well, you can do it for $10,000-15,000 a ton. No, not really, right? You now look at sort of the numbers that are embedded, $20,000-25,000 a ton. Probably not, right? That number sort of just goes up and up and up, right? And of course, there are exceptions to that.
It's very similar to lithium. The price of lithium is whatever, 12, 13,000. It's 9,000 copper, but capital intensity of projects for lithium on the low end is $25,000 a ton. On the high end is as high as $70,000 a ton.
It's kind of simple. The maths is kind of simple. You need that ratio, right, to be somewhere, right? Because it's just a sort of, conversion of that sort of ratio, into, some a level of, sort of that will encourage sort of supply. So, we aren't at that number today. And of course, you sort of think about what's happening. It's sort of, the price minus the cost times the multiple less the capital intensity on a unit basis equals the value accretion of investment.
How do you value? I haven't looked carefully at Philo Corp, but it's being bought for $3 billion. I think it's cash, and now BHP and Lundin are going to. I don't know how much capex is this going to take to build. I'm looking at, within a month of each other. Pilbara is buying Latin Resources for about $400 or $500 million. So there's like a dichotomy there. But again, I don't know Philo versus Latin, but clearly M&A is heating up. That's a sign of a bullish market. In Pilbara's case, they're saying it's counter-cyclical on the bottom. In the case of Philo Corp, I think it's reflecting more bullish stance. And you've seen Glencore try to take over Teck. Obviously, BHP for you. A lot of this is copper related, but there aren't that many. Also, like I said it earlier, lithium's attracted a lot of exploration dollars, and it's relatively easy to find. Copper has not attracted that many exploration dollars, and it's harder to find. So, Robert Friedland's done great in the DRC. Philo Corp, is a bit anomalous. Like, are there other discoveries out there? Like, how can investors? There's a gamut. You can invest early stage exploration and hope for kind of the 10, 20 baggers. You can invest in a big cap like yourself that is unbundling, non-core assets. As a means. Like, how do you? I know you represent Anglo, so you're somewhat limited in what you could say. But if you could go back to when you were a fund manager or a sell side analyst, how do you help our viewers kind of navigate and pick? If they want to buy individual equities.
A number of things, and I'll sort of try and sort of tread carefully here. But clearly it comes with a sort of time horizon, right? A risk tolerance. And kind of where we are in the sort of cycle. The early stage, as you say, that's where you can get the multiple. That's where you can get the real sort of impact. And the thing to look there for, that you're looking for there is geological quality. I remember when sort of started covering sort of Ivanhoe, and I sort of saw the drill results, and I just assumed that someone had given me a decimal point in the wrong place. I was just like, dude, you just don't get that's yeah. And Robert was no, this is the real deal, Paul. And I was like, and then suddenly, you start to sort of do the math, right? That's what you've got to sort of see. That where you have that sort of exceptional geology, those are the assets that will just be, those are the assets that will come to the fore. Those are the assets where there will be real competition from not just the majors here, but from the Chinese, from, everyone, and so on and so forth. And that's really what you're sort of looking for. And, what you're sort of, I think, trying to sort of find is, a combination of, that sort of, exceptional, superior. Look, nothing's going to be quite like Kamoa-Kakula by way of, you're not going to find that again. But you want something that is at least, above the average, better than the average. And where you can sort of ally that to sort of some, the creative genius of someone like Friedland, then you've got a really sort of, a real, a really sort of strong case. But even in that case, right, it's going to take time, and we're going to be through the cycle, and we can all sort of, we all sort of knew what, the ups and downs of this sort of, the macro, and you've got to be willing to take that risk, and you've got to be willing to tolerate it, and you probably need to be able to trade in and out of that, as and when, the cycle sort of dictates, right? And I think that that's an important point, right? Because as you sort of said, right, is this sort of buy and hold? If you've got a very long-term sort of investment horizon, then yes, you can do that. But otherwise, you're going to be needing to sort of take profits, as they arise, and sort of reinvest when the sort of cycle sort of turns in your favor. This is the sector for sort of, it requires the sort of understanding, and having that sort of value investor appetite, whilst at the same time understanding when you've got sort of momentum in your favor. And I think sort of, you have to have both attributes to be able to sort of navigate investment in the mining industry.
It looks like the momentum is in our favor. You're seeing M&A, but you're saying valuations are still very low, 4, 5, 6 times EV to EBITDA. They're not growth multiples. Companies are, major mining companies continue to pay back, on dividends. There seems to be some loosening from, the AV Hambros of the world saying, not just pay back, give back cash, but actually invest in some growth. Yeah, just like, where are we? Like Rodney and I, we've been working through this. We think with a 5-year view, copper looks good from a supply demand perspective. As I said, it hasn't attracted a lot of exploration dollars because the major companies have been paying back, giving back cash, and the Philos and the Ivanhoes are few and far between. So the copper price should rise. Commodity equities follow commodity prices. There could be a lot, of speculation if copper price continues to rise. And we thought we had that when it went to $5 a pound, 10,000 a ton, but it was extremely short lived. So you're saying like you got to be a nimble trader, but is this a good dip to buy broadly for copper equities? Like I own the copper ETF. I've owned it for a long time. I got caught up in this AI. I bought a little bit more, close to the top, in April, May. But I'm again, we're quite optimistic. Should we go to 10,000, and how far? Like, what are consensus forecasts? What's Robert saying? He says it should be infinite, but like, what what do you think the long-term incentive price for copper needs to be?
Infinite's good. Infinite's good. Look, I mean, look, what I'll, without sort of wishing to sort of give, the sort of, kind of the Anglo number, as it were. I will sort of say, if you just look at the sort of regression of sort of analyst consensus versus the spot price, all it will tell you is what the spot price was last year, right? The prognosticative power of analysts' sort of forecast is precisely zero. So I think one's got to be sort of careful there about sort of anchoring too much, into those, into those numbers. What I will say is that the long run trend line, right, for copper is clearly upward sloping. So we'll always have the sort of cycle, and and look, we've come off whatever it might be, 10, 15, 20%. I can't remember from the, the exact numbers from those, whatever the exact sort of high point was, right? And always sort of averaging down into it is, I think, the right idea, right? As it falls, you buy more, right? And that, as sure as onions are onions, right? There will always be in our industry an opportunity to take profits if you can sort of, if you can sort of, hold the nerve, through that, through that volatility. What is the structural trend line here? Is it an inflationary or a deflationary dynamic at work in the mining industry? To believe that it was a deflationary dynamic, you would have to believe in a step change in the underlying sort of cost structures, right, that we simply aren't seeing. Other than that, it's therefore going to be an inflationary dynamic, and there'll be the cycle on top of that. But as long as you've got an inflationary real price dynamic, you're always going to have, right, an opportunity. Time is working in your favor. In other words, time is your friend here, right? So sort of pick the entry points and just sort of hold one's nerve.
Okay, that's great. Could you just, Paul, like end on Can you talk about Anglo's copper assets? Because I don't know them so well, but that was the crown jewel that BHP was going after.
Yeah, I mean, look, so we've got, I mean, look, I would say sort of three of the very best, copper assets in the world, right? We have, Quellaveco, which is our new copper mine that we built in Peru very recently. And again, this was one of the few sort of mining projects that was actually on time and on budget. And I think that's a sort of testament to sort of the hard work in the hard yards that went into the project, prior to the sort of go decision in terms of building and maintaining that sort of social license to operate, and in terms of sort of really sort of trying to do this, in the right way. Takes a bit longer, but that's that's the way to do it. So we've got Quellaveco, Collahuasi, and Los Bronces. Those are the sort of three big systems that we've got. Collahuasi, it's a joint venture with with Glencore, probably one of the best sort of copper mines on the planet. Los Bronces, huge endowment in that sort of broader Andina area and complex, multiple sort of options for for further development of that asset, including the Los Bronces underground project that we've spoken about quite extensively and publicly. So we've got sort of three very, very large, scalable, high quality Latin American style porphyry systems that stand behind the mainstay of our copper business.
Okay, great. And Paul, this is Rockstock Channel. I don't know how much videos of ours you've watched, but for the teaser, we always ask our guests if they have a favorite rock band or song that is their favorite or reflects their personality or the theme for their company. So I'm sorry I put you on the spot here, but if you can think about that, if you have an answer now, great. Otherwise, you can email us what. But we're thinking about calling this Red Bull, Dr. Copper's Paul Gait as a title. So we are the lithium ion bull. So the Red Bull, the high caffeine.
I'm trying to think here about, I'm sure there must be, if I had to sort of say something, I'm sure there must be a Bob Dylan song somewhere that speaks to the industrial sort of Midwest. And it would probably be something on those lines. So if I've got to think about a rock band, Bob Dylan.
Okay.
Does that count?
It certainly counts. Maybe we could say the times they are changing back. We're going back to where I got my started, where I got my start.
That's
okay.
Nice. That's nice.
Thanks a lot, Paul, and hope to have you back again as we navigate volatile copper markets.
The volatility is, look, we know we've been here long enough. It's always going to be with us. But it'd be a pleasure to come back and a pleasure to speak to you, and really, really great to make the introduction again. Cheers, Howard. Cheers, Rodney.